So as we look at the economy going forward, we think that some of the negative headlines around the ultimate demise of this expansion are really unfounded. Let's be clear, the economy is slowing. We know that, but it does not necessarily mean it's contracting. The one thing that we do know for sure is that a recession will come. They always come, but we cannot pinpoint the exact timing of it. What we can say is that there has not been enough evidence by those sources of volatility in the third quarter that suggests those are the factors that are going to drive us into an imminent recession. Let's take a look at the estimates for economic growth. Now, in this next chart, this shows the current estimates for economic growth in the coming quarters. And yes, economic growth is supposed to slow. But we are talking about being in the midst of the longest economic expansion on record. It is not uncommon to have ups and downs, and we've seen that occur. You can see that in the red circles on this chart. We've had periods that were globally driven where we saw slowdowns in the US economy. And what we can tell you now is what's going on with the trade war is filtering into certain areas of our economy. It's filtering into our manufacturing. It's also filtering into business spendings. These are some of the factors that are resulting in a slowdown in growth, not necessarily a contraction, but a slowdown. One of the biggest supportive factors that we have in the US economy is monetary policy. Keep in mind that monetary policy is actually one of the things that has historically been a cause of a recession. But in this instance, we cannot say that is the case. If you look at this chart is showing you that our real Fed funds rate, which takes into account inflation, is basically zero. We have never entered a recession period when we have a real Fed funds rate this low. So you cannot say that we're going to enter a recession because of some sort of policy error. Now let's look at some of the other supportive factors in the economy. If you look at this table is showing you that yes, our manufacturing sector is contracting. We are having much softer manufacturing data. However, look at the drivers and what really makes up our economy. That is the consumer. Look at some of these consumer indicators, whether it's payrolls, the unemployment rate being at the lowest level since the late 1960s, whether it's looking at consumer net worth, it's $133 trillion. To put that in perspective, world GDP is only about 80 trillion. So our powerhouse, our US consumer, is still very strong, and the indicators that to continue to support that consumer are also there, specifically the labor market. Now, what we're also seeing, as you can see in this table, is housing is starting to get a boost from the low interest rate environment. If you look at new home sales or building permits, some of these numbers have jumped up significantly higher than their cyclical average. This is a positive for the US economy, and we can actually start to see housing additive to the economy. So just to summarize, we are slowing. Our growth is slowing. We have often said that we are much more insulated to the global trade tensions, but we're not immune. So we're seeing some of that slowing, specifically in certain segments of our economy. But we do not believe that that is going to be the factor that will ultimately drive us into a recession. We have an extremely healthy consumer balance sheet. We have a healthy corporate America, and now we have a very low interest rate environment. These should be supportive factors for our economy and supportive for this expansion to have room to run.